Hello and welcome to a brand new show of Market Makers. Whereas markets in the short term, they are often obsessed with events and with market moving aspects. The outcome of US presidential election, many commentators believe, would be binary and would have a short-term impact on the market. What Fed will do in the month of December, that topic has been discussed extensively and excessively by global commentators. But my guest on this edition of Market Makers is someone who genuinely believes in identifying and participating in long-term trends and believes in identifying the imbalances in the market. Kenneth Andrade is back in a different avatar. He is now founder and chief investment officer of his own fund, Old Bridge Capital Management. Kenneth, fantastic to have you back and thank you for joining us.
Thank you, Nikunj.
I got the introduction right.
Perfectly.
This is your own fund,
this is my own
firm,
fund, own
new
firm.
avatar.
I've been doing this for a long time. It's just a company that's changed, and it belongs to me completely.
Different capacity.
Different capacities,
Okay.
yes.
Before we talk about where the fund is headed and what you're buying and what you intend to buy in the fund, let's talk about the setup. The setup is that everyone is hopeful that earnings will recover, which is not happening, and everyone is confident that liquidity is abundant and central bankers have got the back of the financial markets. And both the hope trade on one side and the comfort trade on the other side, both these trades are getting crowded.
Well, it's been happening for a very long time now. Okay, and if I step back 3 years back and look at the markets and I look at them now, we put the same multiple and we put the same liquidity arguments to it. The stocks have changed. Okay, but over a longer term period, I'm not too sure by playing the higher valuation game, okay, you will make disproportionate amount of money in this environment. Because over a long term period, you need both variables working for you if you have to compound long term money. You need to buy a low value business and you need to see it compound earnings. Now you have to have both those variables work for you to compound money at a rate higher than what the markets are. So from a strategy point of view, I like to buy quality businesses, but I'm not going to disproportionately pay for it.
Historically, Kenneth, we've seen that the great compounders or the great franchise, they've always come from consumer side or companies which have some IP related stuff. Now, consumer franchise and India, at least the consumer staple part, are very expensive. A stock like Nestle, which you've owned in the past, is trading at a P multiple of 70. So what's going on? Why are some of these quality companies trading at prices which are ridiculous in nature?
I think you will get the seasonality which comes through at different points in time. And if you step back between 2007 and probably 2009, all these businesses were probably trading cheaper than the cyclical part of the entire economy. Okay, and the argument at that point in time was cyclicals have growth. Today, the cyclicals do not have growth because the near-term visibility is extremely crowded. And you always have crowding out effect of capital, and crowding out effect of capital has gone into some of these consumer names or some of these structural plays, that so-called structural plays, and taken multiples taken pricing of some of these companies to fairly expensive levels. So my sense is, if you sidestep some of these trends which are very near term in nature, I think you will get long term opportunities to pick these companies at a later date. So they are good businesses. They've always been good businesses. They've always generated significant amount of cash flows. But like I said, the framework has to be at what price can you buy them. And if you do not buy them at the right price, probably a wait period is much longer than what you initially envisage.
Are you getting a sense that the leadership in the market has started changing because IT, pharma, consumer staples, some of these stocks are taking a back seat? The price-wise correction and also time-wise correction has already kicked in the HULs and the Colgates of the world.
That's true. So I wouldn't say that the leadership is changing, because leadership changes probably every once in 5 years. And for the last couple of years, or if you even step back about 3 years back, you couldn't get enough of pharma. Today you can't get enough of financial services. And those are trends that happen at various periods of time. But I just like to point out, if you step back at 3 years back again and talk about pharma, they were fairly well priced in. And when you price in a product and you price in an environment fairly well, you basically keep no margin of error in terms of performance. And that's exactly what happened with pharma. So today, I have never paid these kind of multiples for a financial services business. It doesn't really matter how fast they've grown in the past.
But they're still growing, Kenneth.
They're still growing near term, but this is the time, I mean, this is monetization time. Okay, you try and extend a financial services balance sheet by 30% for 5 years and see what happens to it. Okay.
But we've seen success in case of a Bajaj Finance or an HDFC Bank. Large base, yet they continue to compound. HDFC Limited also, they continue to compound. Whereas I buy an argument that if the balance sheet size is above 25,000 crore, some of these companies will slow down. But the size of opportunity, as many experts say, is so large and India is so underpenetrated that growth is going to be permanent.
So go back to the to the 90s. For every one large private sector bank that came out, how many went under? So I think it's largely execution that plays a key role in determining the outcome of a business, and not really an entire segment of the market doing extremely well. That segment of the market has done extremely well over the last three or 4 years, but the time to buy those companies and make those compoundings is probably gone by. I would still think you'd manage this euphoria for another year, or it might just last another year. But the disproportionate amount of returns that you made in some of these names that you've talked about, I think that's behind us.
You've always believed in buying stress or something which is in distress. If I look at pockets of distress, I can count on my fingertips, literally, because there are not too many pockets of distress in this kind of market. Commodities, little bit of cyclicals, and large cap IT. Let's talk about all these sectors.
Well, distress in terms of stock prices, not distress in terms of business. Okay, and all these three companies, all these three segments of the market, you've seen base level earnings that have been established in between 2013 and 2015. I think your valuation metrics have to be based on the base earnings that have been there. If you look at structurally, none of these businesses are expanding. Okay, and if you do not have an industry which is expansionary, I think capacity utilizations within that entire system contributes significantly to profits. So I think that's what attracts us a lot. Base level profitability, I can identify with stock prices and base level profitability. I can see cash flows coming through in the cycle because there's no more incremental amount of investment going into the ground. And what more do I want as an investor? I want cash flows back to me. So I don't believe in funding growth. I like to take cash flows off the table at different points in time. I do like growth markets also, but they have to come, most growth markets start off when the industry is very consolidated. I'm a big believer that, that once you have supply constraints, okay, you will get pricing power. Pricing power is never determined by demand, because demand, as far as a country like India or globally, it generally moves by between 5% or maybe 10%. Okay, because that's the so-called GDP number that India grows by. So demand will always be intrinsic to India. You will grow by 5%, but if you have no supply coming in, you probably have an industry run out of capacity in like 4 years. Okay, and in 4 years when you get pricing, you will get a disproportionate increase in profitability.
So that is what could happen to commodities. You feel that once demand trends pick up, at least on the industrial side, demand for metals, demand for rubber, demand for industrial alloys, everything will make a comeback.
I'll be a little more niche because
Give an example.
I won't want to step out and say that I understand how global commodities play out. But yes, anything that is intrinsic to India.
Give me an example of a commodity which is intrinsic to India, because I can only think of cement, and in cement there is no distress.
Okay, yeah, you've highlighted bulk commodities, one large bulk commodity which exists. But for every industry which is bulk commodity industry which is cement, you've got a number of other ones that also exist. Cement is a bulk commodity. Then you can put together fertilizers, you can put sugar there, you can put paper out there, you can put textiles out there. They all form some part of the commodity cycle, etc. And if you look at the entire chain of companies there, along with the metal businesses, I'm not even ruling them out. Along with the metal businesses and the ore businesses, no one's putting capex up the cycle. Okay, and that's a fairly interesting space. So what do I get out there? I get cash flow paybacks. Okay, any distress in margins that come from operating business gets compensated because debt is going to virtually zero on these balance sheets. Okay, so profitability is not going to fall. My cash flow, irrespective of the next cycle of whenever these businesses go, is going to be constant. Okay, and then I have to wait for an industry uptake because no one's expanding balance sheet.
So your big call is that if you are sitting on financial services, monetize them. If you're not buying into commodities, it's time to really revisit commodity as a group. It may be industrial metals, it may be textile, it may be papers, but in next 1 year, commodity related plays or commodity related stocks will make money.
See, I'm a buyer of capital efficiency at a price. Okay. 3 years back or 4 years back, probably turn of the decade, you had all these financial companies trading below book. Okay, what has dramatically changed in 5 years that all of them trade at between 3 times book and 5 times book?
So they are not justified.
I'm not saying that. I'm just saying that what has dramatically changed for them to trade at 3 times to 5 times?
Dynamics have changed. Your cost of lending the way you were lending earlier, your methods like CIBIL and Aadhaar, they are making your lending better.
But that was there at the turn of the decade. Okay, and you had the same metric that was there. Today they're fairly expensive. So I go back to the same thing. What price am I getting it at? And if I have to compound capital right now, the last round I compounded capital is when the price to book moved and earnings compounded at 30% plus. Okay.
So what scenario are you
So today, even if you compound the earnings by 30% plus, will your price to book actually move upwards?
It cannot. It has like for a HDFC Bank or others, it has hit a ceiling.
Okay. So my sense is when I'm going into battle, I need both my hands moving. Okay. I can't tie one at the back and say I'll just bet on earnings growth, because then if I run into a wall, I mean it can move the other way. So you've got an earnings growth which is stagnant, and then you'll have a derating of your multiple also. So multiple re-ratings don't happen constantly on the way upwards. Okay, which is why I'm very sensitive to where we put a portfolio into play.
Okay, let's talk about IT. Now, right now you can smell distress. A lot of people have actually written an official obituary for IT. But these companies are great companies. A lot of cash, they continue to grow. Return on equity, return on capital, again, not that bad. Can IT companies make a comeback?
They always have in the past.
But the challenge this time is that what's going on in the world is unreal, and there is a generation shift which they are perhaps not equipped for.
But Nikunj, if you have to look at every business in that way, and everything going well for the business and cash flows increasing, and you buy it at an expensive price and hope these things never happen. So where are we in the cycle? Why do you get them at these valuations? Some of the large cap, erstwhile blue chips or still blue chips are available at low double-digit multiples.
But the growth, Kenneth, a decade ago, I'm not even going a decade ago, let's say 5 years ago was in late teens, now it's in single digits.
How many of us have been able to predict growth so accurately?
And
growth is based on what? Last 2 years of performance.
Yeah, of course.
So
growth can make a comeback.
It can always, I mean, these are businesses that have organizations that have grown through stress cycles and have always come back. I can't see any reason why they can't reinvent themselves.
The definition of large cap IT has not changed, at least in the 15 years I've tracked financial markets. It's always been Infosys, TCS, Wipro, HCL Tech. Do you think this time around, if one is betting on the sector, you are better off buying the large guys?
You create a bouquet of them. You can capture a couple of niche companies, capture companies which are large and have multiple avenues of incomes. I think you can create an entire basket of them.
The other pocket of, at least from a stock market standpoint, of stress and distress is engineering companies. Earnings are not there. These are great companies. Some of them don't even have a debt. Market men don't realize that. But the challenge for engineering companies and some of the niche guys like ABB, Siemens, Cummins is that the demand is not there. And we've been waiting for this demand to come back for the last couple of years now. And yet, I don't see the green shoots.
I go back to saying, how many of us have been able to predict demand for the last 5 years or maybe the last decade? Okay, in 2008, we compounded ourselves 30% plus going into explaining valuations of why some of the large engineering companies should trade at 40 times multiple and going up to 60 times multiple. Sure. Okay, and we come back again saying that these businesses, we can't predict growth. But look at the flip side of it all. All of them are trading at below the 10-year averages of price earning multiples.
So what do you favor?
So you get an opportunity that's there. You have to pick execution, because every business is going to, every different business and every different vertical is effectively going to vie for leadership in their category. And that's all you need to do, because 1 or 2 or 3 of these companies come back. All of them don't.
The way to look at engineering companies is there are 2 broad clusters. MNC engineering companies which have a lot of technology, a lot of R&D advantage, but are relatively expensive. Then you've got the domestic guys, low margin business, but they are completely related to government spend. They really understand, they're street smart guys. So which way are you leaning?
I'd always buy a company with a great product profile.
So you would vote for MNC engineering?
I would always buy a company with a great product profile.
The way your portfolio is structured and what you've told us is that you don't have exposure to financials and you don't intend to buy financials.
Not in the near term.
That's a big risk, isn't it?
Actually, it's a big opportunity.
That's 35% of your weightage.
Well, the luxury I have in a format like this is I don't necessarily need to track the markets. And if you try and build a portfolio with an absolute return over a period of time, you have to make lesser amount of mistakes as you go forward. And I think we're trying to institutionalize how do you not make mistakes. So you have to capture a very large margin of safety. I don't want a downside in my business, in my portfolios. The upsides will come because cyclical recoveries in every industry takes place maybe in a 5-year cycle or in a 7-year cycle. But that's a patient wait as you go forward.
So where are you confident of a cyclical recovery?
So it's actually going to be fairly broad-based.
The recovery?
Yes, it's going to be fairly broad-based. And I can't time it, but I think 3 years or maybe 5 years from today, we won't be having this conversation of where is the cyclical recovery. It's going to be broad-based because balance sheets in India have started shrinking dramatically. 2, no one's expanding. There's no private sector capex. Cash flows in the system are going down either to pay back debt, okay, or going into company balance sheets itself. So that's not very good for ROEs in the business, but none the same. It's increasing the financial capacity of a business to expand in future.
Fair point.
Okay, so balance sheets are not expanding, and you will have a disproportionate amount of write-offs maybe in the next 1 year or 2 years, which will bring down debt even further. I think then corporate India will be will fire on all cylinders, because you operate somewhere between 65 to 70% capacity utilization. Those are broad statistics that stand out. A 5% growth. Okay, a 5% growth or a 7% GDP growth, you take a pick, and you'd come close to a 75% capacity utilization maybe in 3 years from today. Okay, at 75% or 80% capacity utilization, you start getting some element of pricing power. Okay, and that's the inflection where profits could significantly.
But we could be 1 year, 2 years, 3 years, even 4 years away for that.
I did the computation for you. 70% capacity utilization, you take 65. You give an average GDP growth 5%. 3 years, 5% is 15%. 65 goes to 70, 80%. 80% you get pricing power.
So you're almost there. If I
in the next 3 years, yes, we are almost there.
You're almost there. Okay. In the past, the way you manage funds is that you bought into Page Industries, you bought into Arvind Mills, you bought into Blue Dart. Now today, if I look at the P multiples for some of these brand owners, franchise owners, they're expensive P multiples. Do you intend to buy any of the so-called consumer-facing businesses in the fund?
I like consumers, they're structural. I don't like the multiples they trade at. So you will probably get opportunities once in a while in some of these names. I think we're closely looking at that format.
So staples are out, but what about indirect plays? Like you buy a PVR, you bet on multiplexes, you bet on other consumption habits. Are you looking at hunting something from those in that field?
I think the challenges are the same. It's too crowded a space to be in currently.
But you can't construct a portfolio which is only made of IT or for that matter engineering or commodity.
Like I said, I'm not constrained by the markets at this point in time. And if I have to put a product into play which is going to be absolute return, I have to look at spots of opportunity which is getting disproportionate amount of capital. Okay, we basically think rural India is going to get disproportionate amount of capital from the government balance sheet. So that could kickstart one big a big revival in that part of the world. Remember, that's also 60% of your population.
So do you buy companies which touch down the pyramid customers?
So the way we see it emerging is that agriculture till today has been largely cost-based. Okay, and the various initiatives by the government that's taken through, we tend to believe over the next 3 years there'll be a more productivity-based approach to that part of the world. If you have that coming through, if you have a productivity-based output coming through, you probably see a capex revival in
So buy companies which are in tractors, buy companies which are making seeds, buy companies which are giving you fertilizer, maybe buy companies which
you go right through the value chain. Okay, you can see what one good monsoon can do to the purchasing part.
We've seen tractor sales.
Right. Now, Now let's imagine or let's believe that the policy framework that has been put into play limits the downside for an agriculturist, okay, or for a farmer. So if that plays out, okay, or if this farm insurance policy plays out, and I was pleasantly surprised to see most of the insurance companies, general insurance companies, now talk about that big opportunity which is standing out there. So it's a capitalist opportunity, so it's not just a government subsidy opportunity. And if you limit the downside in income, okay, then what do I have to play for? As a businessman or as an agriculturist, I only have to play for the upside.
So if you're making a case that corporate India will have a better balance sheet, a lot of so-called non-core assets which a couple of prominent groups have decided to sell down to retire their debt, eventually the lenders would also benefit. Where does banks fit in then, especially wholesale banks?
So I think we've spent a very large part of this decade, okay, talking about write-offs and write-offs and write-offs. I think the next 2 or 3 years you'll be talking about bank margins, which I think would be would shrink quite dramatically.
What is your take on pharmaceutical? Again, there is a lot of distress which is there.
Sure. I mean, I think there's, again, we go back to an industry which is fairly well matured. Okay. Valuations are quite, I mean, at an aggregate level, they still are expensive, but you get opportunities across the entire chain. We're looking for companies with a good product line, or we're looking for companies which are fitting our valuation framework.
At this juncture, are you fully invested?
No, we're just about closing the fund.
If I look at the disconnect between large cap versus small cap, the disconnect is historical. Large caps are at a discount, mid cap are at a premium. Do you think this will sustain on a larger level?
So my entire sense on the large caps is that there's too much of damage that has happened on the capital deployment, and ROEs have shrunk permanently.
Permanently.
So you take your large businesses that exist. I mean, you take your telecom frameworks, you take some part of the banking system, okay, and some part of the and a very large part of the utilities. The amount of capacity or the amount of balance sheet that's gone in there, it's going to be a struggle for some of these businesses to generate significantly or come back to their original ROEs.
So where do you think there could be a scope for P expansion and earning expansion?
I think look at domestic businesses, look at niche players, okay, and something else has got to lead this market on the upside. I don't think you will have your same names, okay, that you've had around for the last decade lead this market forward.
Our viewers know about your IDFC portfolio. How much of your stocks are going to be replicated in the new portfolio?
Very marginal.
Very marginal. So which means that this new portfolio, the new fund would be completely different.
Yes, very different.
Even your all-time favorites like Avatek, Vabag, Vardhaman, they are not going to be replicated?
Oh, some part of it might be there, but I mean, like a big scale of those consumer names will not be there.
In terms of a great business or a great company, I'm not getting into whether you will buy it or sell it. What would you call it as a dream company for an investor, and why?
The name?
The name.
There are lots of them there. But I don't think companies would. I basically tend to believe that I can't see more than 3 years down the cycle, and even if I see 3 years down the cycle, I'm not trying to project demand out there. I'm just seeing how balance sheets will essentially consolidate. So I know about Jockey because of the franchise he had. I bought Jockey because of the strength of balance sheet that he had built up, and he created financial capacity to expand his business forward in the face of no competition.
That same cycle you think is now starting with engineering companies, with commodity companies and IT companies?
Exactly.
What would you avoid in this market?
I think anything which is high in disproportionate amount of debt on books. Okay, any business which is hyper competitive at this point in time, I'd just be out of this.
So NBFCs is getting hyper competitive. Housing market is getting hyper competitive. The retail banking business is getting hyper competitive. So by that logic, these are businesses you would like to avoid.
They are nowhere in a valuation zone that I'll be.
The PMS business is also getting hyper competitive.
Sure, we'll see how it works out over the next couple of years.
But the idea is to do something differently, and the mandate is to give absolute return rather than chasing the benchmark.
That's how we set it up.
Appreciate your time. Good luck with the fund and good luck with your new venture. Thank you for your time.
Thank you, Nikunj.
That's it on this edition of Market Makers. Thank you for tuning in and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.